What if I told you that for less than the price of a dinner out, you could own a piece of a luxury skyscraper in Manhattan? No mortgage, no landlord headaches, and no six-figure down payment. This is fractional real estate investing, and it's quietly turning regular people into property owners. Stay with me, because by the end of this video, you'll know exactly how it works and how to start.
For over a century, real estate was the ultimate rich person's game. You needed hundreds of thousands of dollars just to get in the door.
The average person? Priced out. Forever renting, watching property values climb while their savings account collected dust. Let's change that.
But something changed. Technology rewired everything. And today, a brand new model lets anyone own a fraction of premium property, from beach houses to commercial towers.
In this video, we're going to cover exactly what fractional real estate is, how it actually works, how you make money from it, the real risks most people ignore, and the top platforms available right now. And stick around, because near the end, I'm going to reveal one critical mistake that even smart investors make with fractional real estate. It could cost you big if you miss it. All right, let's get into it. First, what actually is fractional real estate? Imagine a $2 million apartment building. Normally, one person buys it, or a bank does. Fractional investing slices that building into thousands of digital shares. You buy a $100 share. Your neighbor buys a $500 share. A teacher in Lagos, a nurse in Manila, a student in Berlin. Each becomes a co-owner of the same building. Every month, when tenants pay rent, that income gets distributed proportionally. Own 0.05% of the building, you get 0.05% of the rent. Simple, elegant, scalable. Think of it like owning stock in a company. But instead of a corporation, you own a slice of a real, physical building that you can see, touch, and visit.
And here's what makes this truly different from traditional real estate: liquidity. Instead of waiting years to sell a house, some platforms let you trade your fractional shares within days.
Now you might be thinking, too good to be true. And honestly, you're right to be skeptical, because there are 3 specific ways this model can go wrong, and I'm going to name all of them, coming up. But first, how does the money actually work? Because this is where it gets really interesting. Part 2. How does the money work? Fractional investing existed in a messy legal gray zone for decades. Then, in 2012, the US Jobs Act cracked the door open, and blockchain technology blew it wide open. Today, the global fractional real estate market is valued at over $5 billion, and analysts project it to cross $100 billion within this decade. That's not a trend, that's a tidal wave. There are 2 ways fractional real estate puts money in your pocket. First, rental income. The property earns rent, you earn your cut, every month, passive, automatic. Platforms like Arrived Homes have paid investors average annual rental yields of 3% to 7%, without them lifting a finger. No maintenance calls, no chasing tenants. The second income stream? Capital appreciation. If the property value rises, and US residential real estate has averaged roughly 4% annually since 1990. Let me put this in real numbers. You invest $1,000 in a property. It earns 5% rental yield. That's another 4 per gains. Total return, $90 on 1,000 turn. That's a 9% return. Now scale that $1,000 across 5 different properties in 5 different cities, available to millionaires. And that's exactly what we'll show you how to do. Keep watching. Here's a real-world example that floored me. A 28-year-old in Austin, Texas invested $5,000 across 10 fractional properties on 2019. By 2023, her portfolio had grown to over $7,200, a 44% return in 4 years without selling a single thing.
That's the power of compounding rental income plus property appreciation, working together, silently, while you sleep.
But let's talk about something nobody wants to discuss at the dinner party: the risks. Because if you walk into fractional real estate blindly, you could get burned. Don't worry, I promised you the full picture. And a smarter investor is a safer investor. Let's go. Part 3. The platforms. Risk number 1, platform risk. When you invest through a fractional real estate company, you are trusting that company with your money. If the platform fails, and some have, your investment could be frozen or wiped out.
In 2022, faced regulatory scrutiny in the US. Not a collapse, but a reminder. Always check if your platform is SEC regulated or has equivalent oversight in your country.
Risk number 2, liquidity illusion. Some platforms promise a secondary market, but if no buyer shows up for your shares, you're stuck. This is not like selling a stock on the NYC in seconds. And risk number 3, This is the one most investors completely miss. I'll reveal it in just 1 minute after this context. Trust me, you'll want to hear it. But first, let's talk structure. How a platform holds your property legally determines how protected you really are.
The best LLC, a legal entity. If one property goes bad, it doesn't take your other investments down with it. This is called structural ring fencing. Know that term? Use it when evaluating platforms. Weaker platforms pool all properties under one entity. If that entity has financial trouble, you could lose everything across all your investments at once. Red flag, walk away now. Risk number 3, the one everyone misses. Are you ready? It's called concentration bias, and it's more subtle and more dangerous than the first two. People invest $10,000 in fractional REIT, then put 90% of it into one building in one city. Then that city's economy tanks. One flood, one highway rerouted, and your entire position crumbles. The solution is simple but powerful, spread across property types, urban and suburban, domestic and international. Diversify like your financial future depends on it, because it does. All right, you know what it is, how you make money, and how to avoid the landmines. Now let's talk about where to invest. The platforms. And there are big differences you need to know. Fundrise OG. Launched in 2012. Open to non-accredited investors. Minimum investment, just $10. They manage over $7 billion in assets. Great for beginners wanting diversified e-REITs. Arrived Homes focuses specifically on single-family rentals and vacation homes. Minimum investment, $100. You pick individual properties, which gives you more control and more connection to what you own.
For the more sophisticated investor, Realty Mogul offers access to commercial real estate deals, apartment complexes, office buildings, retail centers. Easy minimum, $5,000. Higher barrier, but access to institutional-grade deals.
And there's one global platform that's completely disrupting the game by tokenizing property on the blockchain, making ownership transferable in minutes. We're covering that in just 60 seconds.
For European investors, Brickstarter lets you co-own rentals across Spain and Portugal,
with yields averaging 5 to 9% annually. Minimum €50. Yes, €50 to own part of a Portuguese beach villa.
Now, the blockchain disruptor I promised you, Realty. Based in the US, operating globally, they tokenize individuals directly on the Ethereum blockchain. Each token represents a real, legally recognized fractional ownership stake in a physical property. Not a fund, not a share in a company. The actual building, yours, on-chain, provably.
And you can sell your tokens 24 hours a day, 7 days a week, peer-to-peer. No middleman, no waiting list, no business hours.
One Realty property in Detroit, $50,000 total, 500 tokens at $100 each, sold out in just 48 hours. But blockchain platforms carry real additional risks: regulatory uncertainty, wallet security, and smart contract bugs. Now let's talk of the most important part: how to actually start, as a complete beginner, today. Step 1. Decide your entry level. Beginner with $50, go Fundrise or Arrived. Have $1,000 or more? Try Realty Mogul or Brickstarter. Step 2. Verify the platform. Regulated, ring-fenced LLCs, independent audits. Check all 3 before sending a single dollar. Step 3. Start small and only invest money you can lock away for 3 to 5 years. Step 4. Diversify immediately across 5 to 10 properties in different cities and different property types. Step 5 is where almost everyone gets lazy, and it's the one step that separates real wealth builders from those who just tread water. Step 5. Review quarterly. Rental income, underperformers, platform issues. Passive doesn't mean hands-off forever. Step 6. Understand the tax treatment in your country before you ever see a return, because the last thing you want is to hand half your gains to the tax office just because you didn't plan ahead. The smartest investors aren't just thinking about today, they're positioning for what's coming in the next 5 years. The SEC, the UK's FCA, and India's SEBI are all building regulatory frameworks for tokenized real estate right now. McKinsey estimates tokenized real-world assets, including property, could hit $5 trillion globally by 2030. AI is entering the picture too, automatically matching investors with properties based on their risk profile, yield preference, and location.
The single most important thing you can do right now? Don't invest yet. Do this first.
The winners here aren't the fastest movers. They're the most intelligent ones. Speed without strategy is just expensive impatience. Ask yourself this one question first. Do I want income today or wealth in 10 years? That single answer determines everything.
Before you invest a single dollar, write down two things: how much you can invest and how long you can forget it exists.
Fractional real estate is not a shortcut to riches. It's a legitimate, regulated tool for long-term wealth building. The generation before you needed $500,000 and a bank's blessing. You need $50 and a smartphone. The only question left is, are you going to watch this revolution happen, or are you going to be part of it? Drop a comment below. What's your biggest question about fractional real estate? I read every single one. Subscribe and share this with one person who's ready to stop renting their financial future and start owning it.